Hi, and welcome to Midas Investing. Today we're going to be taking a look at my pricing analysis for the small cap indices disaggregated by different US sectors. Now, if you're not familiar, pricing analysis is another term for relative valuation, where you take the current market multiples of various companies and can also compare them against the fundamentals of the companies, and then also compare the results of these against a larger comp group in a larger sample of companies. I think this process is a very useful tool, both for trying to identify new opportunities to maybe do full valuations for, but also can provide a mild catalyst for which the valuations can revert, given that pricing analysis is a little bit more of a simplistic method that is easier for more people to quickly get a grasp on. Now let's take a look. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. All right, now hopping right into the spreadsheets where I do the analyses. If you didn't catch my video that I put out last week on the S&P 500 sector pricing analysis, I would highly recommend that you go watch that video if you want to know finer details of how it is I do this process and what all goes into it, because we're mostly just going to speed run through the results fit for the small cap sectors, because I kind of already covered it largely in that video. Now you'll notice here that there's a variety of companies that are colored. The different colors that are on these sector analyses identify basically which ones I consider to be the more underpriced at various different levels, which we'll go over after I go through the major metrics that we use for each of the sectors. So here we also start with the company, the sector with the largest sample grouping, which happens to be the financials for this one, and then we kind of move down towards the sectors that have the smaller sample sizes, just because I have to start somewhere, and that's kind of the way we go through it. So for the first metrics that we cover for this financial sector, we use EV to forward sales versus tax rate. Tax rate, which is a relatively overall negative effect on shareholder value, given that it's above the net income line. It means that we expect to see a negative relationship, and you can see that there's a pretty solid negative relationship for this metric, with companies that are below the line therefore being underpriced, and companies that are above the line therefore being overpriced. And that's true for all of these charts. Then we have price to book versus return on equity, a pretty solid positive relationship for this one. And the third metric for the financial grouping is dividend yield versus payout ratio. Now, dividend yield would also be a negative metric, considering as dividend yields go up, that means prices are dropping. And payout ratios would also be a negative, considering the higher your payout ratio, the smaller amount of cash that's being retained in the business for you to grow your operations from. But if you combine two negative metrics together on a chart, it ends up creating a positive relationship the way you see it right here. So this is exactly as we would like to see, pretty solid positive relationship. Then moving over to the discretionary consumer sector, for the first metrics we use, we end up using EV to sales versus a forward revenue CAGR over 2 years, according to analysts. And you can see a decently positive relationship for this one, not necessarily super amazing, but solidly positive. The second one we use is EV to forward sales versus operating margins, a little bit stronger for this one as well. And then the third metric for this sector we end up using is EV to capital versus return on invested capital, which is pretty solidly a positive relationship. Then moving over to the industrial sector, the first metrics we end up using is EV to EBIT versus revenue forward CAGR. A pretty solid positive relationship for this one, though pretty bunched up around the lower end of the CAGR. Then for the second metric we end up using is EV to sales versus operating margins. Pretty solid positive relationship for this one as well. And then for EV to capital versus return on invested capital, a pretty solid positive relationship, also pretty solidly bunched up right here. Then coming over to the healthcare sector, we can see that the first metric we end up using is EV versus gross margins versus the revenue forward CAGR, which has a pretty positive relationship for this one. Then we have EV to sales versus gross margins, pretty positive relationship. You can see that the total amount of companies in the sample is definitely starting to get smaller from the first few sectors that we looked at. And then for the third metric, we end up using EV to capital versus gross margins, which this one definitely doesn't have a very positive relationship, but it is positive nonetheless, which is what we expect. We can see that this is definitely one that has a little bit of a weaker statistical relationship compared to some of the other ones we were looking at. Then coming over to this tech sector, the first metrics we look at is EV to EBIT versus revenue forward CAGR. Positive relationship, but not necessarily a super amazingly positive one, but still positive nonetheless. The second one we use is EV to sales versus revenue forward CAGR, which has a much more stronger positive relationship to it. And then the third metric we end up using is price to book versus return on invested capital, which has a pretty positive relationship, though we can see a pretty solid bunching up around the lower end of the return on invested capital spectrum for this one as well. Then we move over to the real estate sector. In the real estate sector, the metrics we end up using is dividend yield versus debt to market cap. As I had already mentioned, dividend yield is one that we would expect to see a negative relationship for if it has a positive metric that's being paired with. But debt to market cap is also a negative metric. So we, as with the other one, would expect to see a positive relationship when you combine the two together. And we do. That's not a super amazing one, but it is positive nonetheless. Then there's EV to sales versus gross margins, which has a much stronger positive relationship for this one in particular. And last but not least, for this one, we end up using price to book versus return on equity, which has a pretty positive relationship as well. Then the next sector grouping that we end up using is the utilities and the communication sector. The Invesco indices that I'm relying on for this analysis, for some reason, combine utilities and communication together into one grouping, which I found to be a little bit strange. But I chose not to separate them out into two separate groups since the sample sizes are starting to get a little bit thin towards this end of the sector analyses. I wanted to make sure I have large enough sample sizes, so I just chose to leave them in as is, even though there's definitely some significant differences between the two. The first metrics we end up using is forward PE versus revenue forward CAGR, which you can see this one is positive, but definitely barely positive. So definitely relatively weak on the statistical strength of this particular relationship. But nonetheless, it was at least the third best that we could come up with, considering we had to come up with at least 3 metrics to use for this methodology. The second grouping that we end up using is EV to forward sales versus operating margins, a much stronger positive relationship for this one. And then the third metric we end up using is EV to capital versus return on invested capital, which has a much stronger positive relationship, as you can see right here. Then moving on to the materials sector, the first metrics we end up using is forward P versus debt to market cap, which we would expect to see a negative relationship for, as we do, but it's definitely on the weaker end of things, similar to some of the other ones we saw. The second one we end up using is EV to forward sales versus operating margins, which has a much stronger positive relationship to it. And then third, but last not least, we use EV to capital versus return on invested capital, which also has a decently positive relationship as well. Then we move on to the energy sector. The energy sector, for the first metric we use, is EV to gross margins versus tax rate. Tax rate we would expect to have a negative relationship, so we do, but it is definitely a little bit on the weaker end of things. The second grouping we end up using is EV to forward sales versus gross margins. Definitely a little bit more statistically positive strength to it for this one. And then the third metric for the energy sector we use is price to book versus return on equity, which has a positive relationship, but definitely also still not the strongest of relationships. The smaller sample size you get, oftentimes you start getting a little bit of weaker relationships. That's definitely somewhat of how it happens. Though there's also the fact that there's differences within the sector that helps to explain the lack of strength in the relationships as well. Then moving on to the consumer defensive sector, this is the last sector that we're going to be taking a look at. And the first chart we end up getting is EV to gross margins versus net margins, a nice positive relationship for this one. And then the second one we end up with is EV to forward sales versus operating margins, a nice strong positive relationship for this one. And then the third one we end up using, also pretty strong, is EV to capital versus return on invested capital. All right, and with that, we've taken a look at all the different sectors. And as I talked about before, I do mark off essentially the ones that are below the 25th percentile of the pricing metric, which when we aggregate all of those different metrics together. And then I also pay attention to the average and which ones are trading at least 1 and 2 standard deviations below that. And then we get all these tickers together and combine them into those different sectors and put them on this page right here, very similar to as I shown in the S&P 500 grouping. And then we run some general statistics on seeing just how many companies in general that we identified at each of these different levels. So you can see in total, we actually analyzed 597 companies across all the samples, and that's after I removed some outliers from each grouping. And then we have them separated off into the different sectors, and we're going to go through to identify exactly just how many companies in each grouping there is. Now, I'm not going to go through and name off every company, every ticker that's listed here, because that would just be me spouting off a bunch of letters, very, very rapid fire, and I don't think that's very, very intelligible or helpful for people that are listening. So if you really want to know which tickers are in the list, this is on you to be able to pause the video, make sure you've got your frame rate up so that you can identify what you're seeing on the screen, and then perhaps go bargain hunting amongst those companies. As I had mentioned before, there's the first quartile level, but it should be understood that the companies that are at least 1 and 2 standard deviations below that do count as being below the first quartile. And then likewise, companies that are in the -2 standard deviations do count as being under 1 standard deviation as well. So essentially, as you move forward to the next column over, it becomes much more stringent. That really the first quartile grouping is everything in all three of these columns, and the things that are in -1 standard deviation is everything in both of these columns. And then likewise, it's just this one column by its lonesome. So I have them kind of separated out according to those different levels. And the way it's set up that way is so that you can kind of look at the companies. You should be able to say, okay, well, I want to take a look at the most underpriced, which would be 2 standard deviations below. And then if you don't find anything you like there, or maybe you have already done your analysis for those companies, then you can maybe move on to the things that are 1 standard deviation and below. And then beyond that, you can move on to things that are only the first quartile and below. And that's kind of like the way you can kind of prioritize your bargain hunting, so to speak. Either way, in the financial sector, first and foremost, we had 117 companies total in the sample, and we have 26 companies in total. No, I want to get this one down here. 26 companies in total that made it into under the first quartile, while we have only 5 companies that made it under the first deviation. 0 that make it under the second deviation. What you'll see is for most sectors, honestly, there's not very many companies that fall under this category. Then coming down to the consumer discretionary, we had 82 companies in our total sample, and we have 18 companies that fall under the first quartile, and only 6 companies that fall under 1 standard deviation for this one. Industrials, we have 93 companies in total in our sample grouping, and we actually identified 20 companies out of that fall under the first quartile, and 5 companies that fall under the first standard deviation. The reason that this one is marked orange is because that's one that I have in my own portfolio already. And in fact, I identified this company through this pricing analysis that I did approximately a quarter ago. So it just goes to show that this process does bear some fruits, but you do have to perhaps look through and identify which business models you like and whether or not there's a proper valuation, a DCF valuation that actually can back this up as well. And it's not just a fluke of the statistics and the current pricing dynamics. Coming down to healthcare, we have 66 companies in total in our sample grouping, and 16 of which fall at least under the first quartile, and only 3 of which fall under the first standard deviation. In technology, we have 65 companies in total in our analysis, and there's 14 companies that fall under the first quartile, and then out of that 14, 10 of which fall also under the first standard deviation as well. Interesting to see that there's more under there than just under the first quartile, but like I said, technically the first quartile includes both groupings. Then in real estate, we have 51 companies in our total sample, and we ended up identifying a total of 9 of which that fall under the first quartile, 2 of which that fall under the 1 standard deviation, and then 2 of which that also fall under the 2 standard deviation. So here there is some companies in the under 2 standard deviation area, but it's worth noting, as I've mentioned before, just because something's underpriced does not mean that it is a good value. There could be a variety of reasons for why something is underpriced and significantly underpriced. There might be some serious risks and concerns. There might be some significant differences between those companies and other companies in the sample that are creating these problems. So the point is, all of this analysis requires much deeper analysis on your end. You can't just run with this pricing analysis and just invest based only on that alone. Then coming down to the utilities and communication sector, I still think it's pretty weird that those small cap indices decide to combine these two together. But like I said, there's only 34 companies in our sample, and I didn't really want to split that up because then we would be much under the 30 sample size that is kind of a statistical bare minimum in general for what is considered a significant sample size. And you'll see that a couple of our sectors actually do fall under 30, but only just barely so. So I kind of just allow for the pricing analysis to go through. But say split this number in half, and that would be way too small in my opinion. So we just decided to leave them in as the indices had them. But anyway, with utilities and communication, we identified 8 companies out of the 34 that fall under the first quartile, and 3 of which fall under the first standard deviation as well. Materials has 32 companies in its sample, and only 5 of which fall under the first quartile, and 4 of those also fall under the 1 standard deviation as well. Energy has 29 companies in the sample, with 7 of which that fall under the first quartile, and 4 of which that fall under the first standard deviation. And then Con Defensive has 28 companies in the sample, with 7 of which that fall under the first quartile, and 1 of which that falls under the first standard deviation. So that's all of the different sectors, 10 of which that we've separated out once you include utilities and communication into one, and 597 companies that have been analyzed in this method. Now, I do like to kind of like run an overall statistic on that to see exactly how much we identified. And companies that fall under the first quartile is 21.8%. So a pretty significant narrowing down from 597 companies down to only keeping less than 22% of those companies. And then likewise, if you go by the first standard deviation, only 7.5% make it under that level. So we're really thinning the herd and narrowing in on a much more select group of companies to perhaps analyze further. And then 0.3%, only two that we saw that fell under the second standard deviation. So my general approach with this is to kind of start with the second deviation column, go through and take a look at those companies and see if there's something special about them that maybe merits a much more full valuation for it. And then if I find something, good. If I don't, then we move on to the first standard deviation and kind of work through those companies, and then kind of likewise just kind of move to the left on the columns, trying to identify opportunities in each of these sectors. And of course, you don't have to do every single sector. Maybe you don't really care much about financials, or you think they're overly complicated. You can just ignore that and just do the sectors that you're most interested in. As I said before, take your time with it, pause the videos, take screenshots, do whatever you got to do, because like I said, I didn't really go through the tickers very specifically. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. So that's going to do it for my pricing analysis following the first quarter earnings this year for the small cap sectors. As I mentioned at the start, if you didn't catch my video last week, which was released on the S&P 500 sector pricing analysis, I would highly recommend you watch that. One, because it is the S&P 500, but also because I do go into much finer detail in terms of like the overall process and how it is I do this analysis in the first place, so it can give you a much more closer idea of what it is exactly that I've done and how that works, because maybe you have your agreements or disagreements with the process by which I do it. Now, my goal is to kind of repeat this process every single quarter after the earnings have come largely to a close. Obviously, some companies are not reporting always exactly in sync with other ones, but the goal is also to try to get it out on a much more timely basis, ideally about 3 weeks earlier in the cycle than this video is currently being released itself. But I also want to combine both the S&P 500 and the small caps sector analyses together into one video, and I'll generally be trying to go through things a little bit faster. For these first two videos, I was trying to go in a little bit higher detail to really kind of make it clear exactly what the process is, but in the future, it'll really just be a much more one video as quick as I can get it through, kind of overview, so that you, the viewer, as well as myself, can kind of get to the bargain hunting a lot faster. So, all right, I'll catch you all in the next pricing analysis next quarter. Bye.